Welcome to The Explainer. Today, we're going to challenge a core assumption you might have about your portfolio, that you're actually prepared for a bear market. Because what if you're preparing for the wrong one?
So you probably think you're ready for a downturn, right? You've got a plan to protect your portfolio when stocks take a hit.
But here's the kicker. Are you ready for the right one? Because look, using a playbook designed for the 2000 tech bust during a crazy fast crash like we saw in 2020, that's not just a bad move. It can be an absolute disaster for your portfolio. So let's really break this down.
Okay, so to build the right defense, you've got to know your enemy, right? And when it comes to the market, it's not just one type of bear you're up against. History actually shows us there are 4 really distinct archetypes. First up, we have the classic bubble burst. You know the drill. Think dot-com bust in 2000, or hey, even the crypto collapse back in 2021. This is when one specific sector gets totally overvalued, just completely out of whack, and then pop, it implodes. The damage then kind of slowly bleeds out into the rest of the market. All right, next is the credit crisis. And honestly, this one is way scarier. We're talking 2008 all over again. This is where the whole financial system just freezes up. It's not about one little sector. This is a full-blown systemic failure where pretty much everything plummets all at once. The only things that really survive are those ultimate safe havens like U.S. Treasuries.
Then there's what's called a policy shock. Now this one's different. It isn't some sudden dramatic crash. No, it's more like a slow, painful grind downwards. It happens when central banks, like the Fed, start jacking up interest rates to fight inflation. And the really tricky part? Even the stuff you think is safe, like bonds, starts losing value right along with your stocks.
And last but not least, we have the black swan. This is that event that just comes completely out of left field. Nobody sees it coming. Think COVID. It causes this incredibly fast, terrifying crash, but it's usually met with such a gigantic response from the government and central banks that you get an equally wild V-shaped recovery on the other side. Okay, so there you have it. 4 different crises, 4 totally different playbooks. Simple enough, right? But what happens if the next bear market is something completely new, something we've never seen before? And that brings us to this potential 5th archetype, the inflationary bear. Just imagine this for a second. Inflation is running wild, totally out of control. But the one weapon central banks have to fight it, raising interest rates, is off the table. They just can't use it. Why? Well, because governments are drowning in so much debt that they literally can't afford higher borrowing costs. It is a genuine nightmare scenario for investors.
So this is really the million-dollar question for every single one of us today. How in the world do you prepare for a traditional deflationary crash and this brand new inflationary threat at the exact same time?
Well, the answer isn't to try and guess which one's coming. It's to prepare for both extremes, all at once. And there's a name for this approach. It's called the BARBELL strategy. It's designed for exactly these kinds of moments of radical uncertainty. The logic behind it is actually pretty simple, but it's incredibly powerful. You just stop trying to predict the future. It's a losing game. Instead, you build your portfolio to be ready for 2 completely opposite extreme outcomes. So you concentrate your assets at the 2 ends of the spectrum, the super defensive side and the super inflationary side. And you deliberately get rid of that mushy middle ground because those are the assets that get crushed in both scenarios. Now, take a look at the allocation here. This is really interesting. It's not just a simple 50-50 split. The strategy is actually leaning more heavily, a full 60%, towards defending against that inflationary bear. What does that tell you? It suggests that maybe, just maybe, inflation is the bigger and probably the less appreciated risk we're facing. So let's break down the toolkits for each side of this barbell. On the left side, you've got your defense against a traditional deflationary bust. These are the classics, right? Cash, long-term bonds, and puts, which are basically like buying insurance on your portfolio. Then on the right side, to fight off inflation, you're holding real assets, stuff that does really well when the value of money is going down. We're talking gold, energy, and other hard commodities. Okay, but a strategy is pretty much useless if you don't know when to use it, right? So the really crucial part here is knowing when to shift the balance of your barbell. When do you lean one way or the other? Well, think of these as your tripwires. They're your simple if this, then that rules for when to rebalance. For instance, let's say the tech sector takes a nosedive, and at the same time, credit spreads start to spike, which just means it's getting a lot riskier for companies to borrow money. Boom! Those are clear signs of a classic bubble bursting.
That is your trigger to shift your weight and lean heavily into that defensive left side. On the flip side, if you see inflation just roaring ahead, but the Fed is just sitting on its hands, looking powerless, or maybe even unwilling to act, that's your signal to go all in on those real assets on the right side. So what this whole explainer gives you is a framework. It's not about predicting the future. Nobody can do that. It's about being prepared for different futures. The real takeaway here is to just stop trying to guess what's coming next. Instead, build a strategy that's tough enough, robust enough to handle whatever the market throws at you. So that leaves us with one final question to think about. Based on everything you're seeing in the world today, which side of that barbell are you leaning towards?